Hi, I'm Dave Sachko, teamsachko.com. The last 2 months of real estate has been fantastic. The market is very hot right now. We're seeing multiple offers again. And with me today I have Al Smith, the mortgage manager for Scotiabank. And we know that there's up and coming changes in the mortgage industry, Al. And can you tell me how these changes are going to affect the buyers?
Great, thanks Dave. Actually on January 17th, the Government of Canada announced some changes to the parameters regarding insured mortgages. So just to provide clarification, an insured mortgage is where a client does not have a 20% down payment. They're putting less than that 20% down. So it has to be insured by one of the two insurers that are out there. So basically what's happening is the amortization period, or the length of the mortgage, is going to be reduced from 35 to 30 years. Okay. In addition to that, on a refinance, so if you want to take equity out of your home, you can, at this point, you can refinance up to 90% of the value of your home, but effective actually March 18th, the refinance amount will be limited to 85%.
Okay, so what you're saying is the 35-year AM is no longer after March 18th.
Correct.
And then homeowners are only allowed to refinance up to 85% of the value?
That is correct, yeah.
Okay. Now, in regards to other Scotia programs, say for our buyers, if say first-time buyers, do they still have the free down payment option? And how does that work?
Actually, it's a product that is actually very unique in the industry. You probably remember a couple of years ago they had a zero down where
Right.
they would finance 100% of the mortgage. The government kind of cut back on that, and what they've minimum requirement now is 5%. So we have a product that's called Scotia Free Down. So we provide the 5% down payment on behalf of the client.
Excellent.
There are a lot of, for example, first-time home buyers, people who have been renting for a while who don't have that down payment. Because keep in mind, when you buy a home, you're going to need your closing costs, legal fees, land transfer tax as an example. So it's tough sometimes to come up with a down payment. So we provide the down payment on behalf of the client.
Now, if any of my clients wanted to get pre-approved for a mortgage, what's the process? What's the step?
Well, actually, what I would suggest, I would contact them, and I would arrange a meeting with them. As a mobile mortgage specialist, I had the opportunity to go see them at their home, place of business, a location convenient for them. So what I would do is I would meet with them at their convenience, gather as much documentation as I can, and basically go through the pre-approval process, whereby we would do a credit check, submit the application, get them pre-approved. We'd have a written commitment, so they would know how much they've been pre-approved for, and at that point you can take them out and show them homes.
In your experience, Al, in pre-approval, do many of the clients know exactly what they can afford, or is it, or do they want a certain number, and then you try to apply it for that, or like how do they qualify? What's the qualification process as far as how much they can?
Well, there's certain guidelines. We look at income and their debt obligation.
Right.
And there's certain ratios, gross debt service ratio, total debt service ratios, things like that. But what's really important for myself and you to understand is what that client is comfortable with in their monthly payments.
Right.
So we can pre-approve you for a certain amount, but you need to be comfortable knowing how much you're going to pay per month. And that's really, really important. It's not about buying the most expensive home that's out there. It's what best suits them.
Earlier on, you were talking about insurers. You said there's two insurers. Who are these insurers?
There's two, Canada Mortgage and Housing Corporation, and the acronym is CMHC, which a lot of people hear that out there, and Genworth, GE Capital. So there's the two insurers. The premiums are exactly the same.
Right.
They both offer the same service.
Now the premiums with these mortgages, do you have to pay them up front?
No. Yeah. Sorry. Yeah. Well, actually, that's a great question. What happens is the premium is added to the loan amount. So we would take the purchase price less the down payment, and then the premium is added to the loan amount, and then we base the payments on that.
And then amortized over 35 years, possibly up until March 18th.
That's correct.
And then now it's 30 years is the longest amortization.
Effective March 18th, correct.
Al, thanks very much for joining me today. You are a very, very top mortgage rep, and I encourage all our buyers who haven't been pre-approved is to contact myself, and I can pass along Al's numbers. Thanks very much for watching. watching this video, and we'll talk to you again next month. Thank you.